On the 23rd of June 2016, the people of Britain voted to leave the European Union, a decision that caught almost everyone by surprise, including politicians, financial markets, big business, pollsters, bookmakers and even prominent Leave campaigners such as Nigel Farage, who conceded defeat shortly after the polls closed at 10 p.m, only to start backtracking a couple of hours later as the actual results started to come in, resulting in an immediate panic as market participants reversed their positions. So whilst the Bank of England was able to contain the immediate market panic, nevertheless economic uncertainty remains extremely high, with the potential for many years of confidence draining paralysis as businesses and investors put off making major decisions until they can see the light at the end of the BrExit tunnel. This video, as part of a series based on my in-depth analysis posted at marketoracle.co.uk, looks at 10 major drivers of the UK economy and markets and of what to expect to happen next. But firstly, for a quick recap of what actually happened on Brexit night that caught virtually all by surprise, then do watch my selection of the highlights from 8 hours of BBC coverage of the EU referendum result, and also see the second video on trading markets during Brexit night that illustrates how all hell broke loose once the polls closed Thursday 23rd of June, triggering a sharp rally in sterling and FTSE futures that was sustained until the actual results started to be announced shortly after midnight, triggering a 5-hour market panic.
Lambs cast 30p each in Just Go! Boom! Lamb.
Going into the EU referendum, the vested interest academic economists from the Bank of England downwards were repeatedly issuing dire warnings of a plunge in sterling that would send inflation soaring, that would trigger a series of interest rate hikes, all whilst the economy collapsed. The prices in the shops, as measured by the official UK CPI Inflation, was hugging near 0% at a rate of just 0.3% for May 2016 data. Meanwhile, RPI, which is the closest official measure to real inflation, was already well above 1% at 1.4%, which are set against the demand adjusted real UK inflation rate of 1.8%. So official UK price inflation was already well above 1% and trending towards 2% before Brexit. Now, more than a couple of months on from the Brexit vote, inflation has nudged higher to CPI 0.6% and RPI to 1.8%, and it's not complicated to figure out why UK inflation is on the rise, for we have two factors at work that look set to continue to drive UK inflation higher into at least early 2017. Firstly, there has been a sharp depreciation in sterling of about 12%, which continues to persist, resulting in an increase in the price of imports and therefore should gradually feed through to higher prices in the shops. However, unless the slide in sterling resumes, then this inflation should prove temporary and start to come out of the inflation indices a year on from the Brexit vote. Secondly, there are the longer term consequences of increased deficit spending stimulus for the UK economy, as Theresa May's government has abandoned George Osborne's economic policy of working towards a budget surplus by 2020. Instead, now everything since is confirming expectations for the UK going on an economy boosting deficit spending spree, aided by the Bank of England, which is literally opening the easy money floodgates by printing as much money as necessary for both ensuring low market interest rates whilst at the same time financing increased deficit spending, i.e. QE debt monetization. Therefore, both of these factors look set to continue to drive UK inflation significantly higher to above CPI 2%, which I forecast in early July would probably spiked to above 3% for January 2017 data, and RPI probably spiking to above 4%. However, beyond that spike, then unless the surge in inflation triggers significant wage inflation, then CPI inflation should then soon start to retreat to back below 2%, probably towards 1%, and then trend towards that of the inflation rate of the US at that time, as illustrated by my inflation forecast graph. The most recent RPI of 1.8% for August and CPI of 0.6% again demonstrate what is increasingly becoming apparent and is contrary to the academic vested interest economists' doom warning in the run-up to the vote, which is that the UK economy is showing remarkable resilience across all sectors, including inflation, that so far is not quite spiking higher despite the 12% drop in sterling implied would happen. However, these are early days, which means import inflation is yet to feed its way through to the supply chain and into the shops, and so take the recent inflation data as the calm before the inflation storm due to hit its peak for January 2017 data as released in February, by which time the UK CPI inflation will be spiking higher towards 3% and RPI to probably above 4% before trending lower into mid-2017. I'm sure the mainstream press in February 2017 will come out with many panic headlines about soaring inflation without realizing that in effect nothing has really changed where inflation is concerned, for we remain firmly immersed in an exponential inflation megatrend, of which the rise towards 4% RPI would just mark the continuation of, when even the great deflation of the Great Recession of 2008 to 2009 is now a mere blip on the long-term inflation megatrend chart. The bottom line is that before the referendum result, the mainstream media consensus propaganda was for a post-BrExit sharp rise in inflation that was expected to trigger a series of interest rate hikes, which I countered at the time by reminding that inflation at above 5% of just a few years earlier had failed to prompt the Bank of England to raise rates due to the bank being terrified that its banking sector brethren would go bust, just like they did in 2008, instead to expect the opposite, i.e. falling interest rates and rising inflation, a trend which the post-Brexit August rate cut and collapse in savings and interest rates confirms, as the following tables from Money Facts illustrates that the cuts in market savings and borrowing rates that are likely to continue all the way towards the outright theft of bank deposits by means of negative interest rates, so savers and workers will continue to pay the price for the banksters by means of sub-inflation pay and savings rates. And do remember to check out the other videos in this 10-part series and subscribe to this YouTube channel for new videos.